So as we previously discussed within our videos that transactions between related parties must be priced at arm's length, which means that it must be priced the same way as it would be between unrelated parties. Also, taxpayers would be required to prove that such transactions have been priced at arm's length. And here to prove the arm's length price, then this would depend on several things, including for instance the nature of the related party transaction, the availability of reliable information and the degree of comparability between related and unrelated transactions, and those analysis would accordingly lead us to choose the most appropriate transfer pricing method, which is the key secret to prove the arm's length price. Well, so which transfer pricing method we should follow to reach the arm's length price? That's what we are going to discuss today within this video, so let's get started. Hello everyone and welcome to the Tax Gate. Hit the subscribe button and let's get started. Normally we have 5 recommended transfer pricing methods, and here it is important to note that each one of them would deliver a different arm's length results covering the same transaction. Good, so talking about the transfer pricing methods, then we would initially highlight that transfer pricing methods would fall into 2 categories: the traditional transaction methods and the profit-based methods. Well, so while the traditional transaction methods would focus on the terms and conditions around the transactions, the profit-based methods focus on the company's overall profitability. So as we were saying that the traditional transaction methods measure the terms and conditions of actual transactions between independent enterprises and compare them with the one of a controlled transaction. However, for the profit-based methods, those methods measure the level of profits realized from controlled transactions and compare such with the profit level realized by independent enterprises in a comparable transactions. Also, for traditional transactions methods, it would include the following methods: comparable uncontrolled price method, also the resale price method, and finally the cost plus method. However, for the profit-based methods, then it would include both profit split method and also transactional net marginal method. Good, here it is important just to keep in mind that there's no right or wrong method, as transfer pricing is not an exact science. It is all about selecting the one that would best fit the company's business model. Also, it would be important to mention that the profit-based methods wouldn't be as accurate as the traditional transaction methods. However, profit-based methods are much more applied, as the traditional transaction methods normally require detailed information, and in practice these information would not be easy to find. Well, now let's talk about each method separately under the mentioned categories. Let's start with the comparable uncontrolled price method, or as normally known as CUP method, the method that is normally preferred by tax authorities, being very straightforward and reliable as well. CUP method compares the price and the conditions of the products or services in a controlled transaction with those of an uncontrolled transaction between unrelated parties. And to have this comparison done, then CUP method needs the relevant comparable data, and here we should highlight that in order to consider the comparable price, then the uncontrolled transaction has to meet the highest comparability standards. In a different way, the transactions must be extremely similar to be considered comparable under this method. And here's the issue: as due to the high comparability standards needed in applying CUP method, it is usually a challenge to identify a transaction that is appropriately comparable to the controlled transaction due to the unavailability of the relevant comparable data. Also, worth to quickly highlight that CUP method can be applied in 2 ways. Internal CUP, which is applicable in case the company has a comparable transactions with related and unrelated parties. External CUP, which uses comparable data of transactions between 2 unrelated third parties. And finally, we would highlight that external CUP would be more difficult to apply due to the unavailability of comparable data for third-party transactions. Good, let's now move to another traditional transactional method, which is the resale price method. The resale price method would be less dependent on a specific product comparability, as it focuses more on comparability of the functions performed and risks assumed. This method would be useful when we are dealing with marketing or distribution activities where the marketer does not have a significant contribution in the business. For instance, when a product is bought from a group company and resold to a third party. And here to have a reliable comparables, the issue would be that it is very difficult to identify whether the comparable businesses do or do not employ valuable marketing intangibles in their business. The resale price method compares the resale gross margin earned by the related party with the resale gross margin earned by comparable uncontrolled parties, and here we would highlight that any material differences in accounting practices can accordingly affect the gross margins of independent comparable companies, which would accordingly affect the arm's length results. Well, and now with the last method under this category, which is cost plus method. The cost-plus method is normally applied in related party transactions that would involve manufacturing, assembling, and production of tangible goods where costs are necessary to be easily determined. And that's why the first step in applying this method is to determine the manufacturing costs incurred in a controlled transaction, and then a market-based markup would be added to the identified costs to account for an appropriate profit. Here the added markup is compared to the markup that would be realized in comparable transactions made between unrelated organizations to confirm on whether it is arm's length or not. The markup should be comparable to what a third party would earn if it performed comparable functions before comparable risks associated using almost the same assets and operated in comparable market conditions. Also, cost-plus method require a very high level of similarity in the functions performed by the comparable companies, and like all traditional transactional methods, the challenge in using cost-plus method would be the availability of comparable data and consistency in the accounting methods. Well, with this we have just already covered the traditional transactional methods, and now let's move to the next category, which is profit-based methods. Let's start with the profit split method. Companies sometimes would engage in transactions that are too interconnected or interrelated to be observed on a separate basis. A joint venture, for example, and here is the use of profit split method as it looks at the combined profits of two related parties being in a transaction that is too connected to both of them. And here the profit split method tests the terms and conditions of these types of controlled transactions by determining how profits would be divided in a way that would be fair for both of them. In a different way, how profits would be divided between third parties making similar transactions. This is especially useful when dealing with intangible assets, such as intellectual property, or in situations where there are multiple controlled transactions happening at the same time. Also, it is important to highlight that profit split method would be used when comparables are hard to find, and given the high level of subjectivity surrounding this method, mostly it attracts the attention of the tax authorities. Good. Now with the last transfer pricing method in this video. The transactional net margin method. Well, one of the main difficulties in applying the transfer pricing methods to confirm on whether a transaction is arm's length or not is the availability of the needed comparable transactions. And that's why transactional net margin method is most widely used in practice, as it overcomes most of the practical difficulties in accessing publicly available needed information. The transactional net margin method tests the net profit margin earned in a controlled transaction with the net profit margin earned by the related party on the same transaction with a third party, or the net margin earned by a third party on a comparable transaction with another third party. The net profit margin can be measured against a number of bases, which would including either sales, costs, or assets, and in practice the operating margin normally would be applied. So, here the transaction net margin method uses the net profit margin as an indication. And that's what we call as the profit level indicator. So the profit level indicator of the taxpayer from the controlled transaction would be compared to the net profit indicator that the same taxpayer earns in comparable uncontrolled transactions, and when this is not possible, then the net margin that would have been earned in comparable transactions by an independent enterprise. Well, so in using the TNMM method, then the selection of the profit level indicator would be a critical aspect, as it would depend on the type of function or activity of the company to be tested, and is just highlighted that the company's operating margin would be normally selected. Good. That was a quick overview of one of the most interesting transfer pricing topics. Like and subscribe for more interesting videos, and thanks for watching TaxGate.